You ever hear that whisper, that rumor in the world of finance? It's this idea that somewhere, hidden away, Wall Street's insiders have the exact date of the next recession already circled on a calendar. That while the rest of us are guessing, they're just counting down the days. Well, today, we're going to pull back the curtain on that powerful myth. We're not just going to tell you it's wrong. We're going to show you why it's wrong and give you a much smarter way to understand how the world of high finance really tries to see into the future.
So let's just ask it straight up. Is it real? Does Wall Street have some kind of secret calendar, a little black book of economic doom? I mean, the idea is tempting, isn't it? It suggests there's some kind of order to the chaos, that while we're all trying to figure things out, the real players are just waiting for a date they've known all along. But the truth? Well, the truth is actually a lot more complicated and honestly way more interesting than any conspiracy theory. Before we jump in, don't forget to like, share, and subscribe. And check out the links in the description if you're looking for a real estate agent in your market or you need life insurance. My team and I can help you anywhere nationwide.
All right, here's how we're going to break this all down. First, we're going to tackle that so-called Wall Street secret. Then, we'll get into how recessions actually get dated, and you might be surprised by how that works. After that, we'll dive into the real world of forecasting, which is all about probabilities, not certainties. We'll look at how markets try to price in the future, why they're so often wrong, and finally, we'll give you the tools to decode the headlines like a pro. Let's get into it.
Okay, so let's start with the myth itself. Section 1, the Wall Street secret. To really get why this idea has such a grip on people, we have to understand what they're actually saying when they claim the next recession is already on the books.
So here it is, the big claim you hear all the time, that the market has already figured it out. That somehow the collective brain of Wall Street has pinpointed the exact day the next downturn begins. You see it in sensational headlines. You hear it from commentators. It makes it sound like they have a crystal ball. But here's the thing, that entire idea is built on a fundamental misunderstanding of how all of this actually works.
And this right here, this is the core of all the confusion. When you hear somebody say the market knows the date, what they're almost always talking about are market-inferred timing signals. It's a fancy phrase, but what it boils down to is this. They aren't talking about a specific date. What they're really talking about, whether they know it or not, are forecasts based on probability. They see a bunch of signals that suggest the chance of a recession is high, and they make the critical mistake of turning a high probability into a dead certainty.
Now, to really blow this myth out of the water, we need to understand the official process. And that brings us to Section 2, how recessions are dated. And this is where the fantasy of predicting the future crashes right into a slow, careful, and surprisingly backward-looking reality. So who actually gets to make the call? Who puts the official stamp on it and says, yep, that was a recession? You might think it's the Federal Reserve or the White House, but it's not. The official referee for the U.S. economy is a single group of academics, the National Bureau of Economic Research, or NBER. They're a private, nonprofit, nonpartisan organization, just a small committee of top economists whose entire job is to look at all the data and make the official declaration. And their process is intentionally slow and methodical to keep it out of the political fray.
And this right here is the single biggest nail in the coffin for the secret date myth. It's a concept called retrospective dating. The NBER does not predict recessions. They identify them, kind of like a historian, not a fortune teller. They officially announce that a recession has begun months, sometimes more than a year, after the economy's already started shrinking. They have to wait for all the data on jobs, income, and production to come in and be finalized. Only then can they look backward and say, okay, that month, that was the peak. By its very definition, it's an exercise in looking at the past.
This timeline makes it crystal clear. First, the economy hits its peak performance. Then the downturn actually begins. That's the technical start. Then, for several months, all the economic data gets collected and revised. Only after all that happens does the NBER committee even get together to look at it. And then, finally, long after the fact, they make the official announcement. So it raises a pretty obvious question. How could Wall Street possibly know a secret future date, when the official referees don't even know a recession has started until they can see it clearly in the rearview mirror? The simple answer is, they can't.
Okay, so if Wall Street doesn't have a secret calendar, what are they actually using? What are all those forecasts you hear about? This brings us to the heart of what they really do. Section 3, forecasting with probabilities. This isn't about finding a guaranteed outcome. It's about calculating the odds. If you take away one thing from all this, let it be this phrase: probabilities, not certainties. Every single sophisticated forecast, every complex model, every market signal,
They're all just trying to answer the question, what is the likelihood of this happening? They're speaking the language of a bookie, not a prophet. It's a calculated assessment of risk. That's it. Let's look at a real-world example. Moody's Analytics, a huge name in this space, has a model that, at one point, was showing a 48% chance of a recession happening within a specific time frame. So what does a number like 48% really mean? It means the risk is elevated, it's significant, it's almost a coin flip. But what it is not is a guarantee that a recession is going to happen. It's simply a statement of heightened risk.
Now, to show you how messy this gets, check this out. Around the same time, a completely different model from the bank UBS was flashing a 93% probability that a downturn was either already happening or just around the corner. So you have one respected model saying it's a coin flip and another one screaming it's basically here. This doesn't mean one is right and one is wrong. It means they're using different data and making different assumptions. This one comparison shows you exactly why there can't be one secret date. Heck, there isn't even a consensus on the probability.
So let's just define our terms. A recession probability is nothing more than a risk assessment. It's a number that tells you the statistical odds of a recession starting, and this next part is critical, within a specified time frame. The forecast is never for October 15th. It's for some time in the next 12 months. It's a broad window of risk, not a specific appointment.
So what are these signals they're looking at? Well, the most famous is the inverted yield curve. In simple terms, this is when it becomes cheaper to borrow money for 10 years than for 2. It's the market basically saying it's more worried about the near future than the distant future. And historically, that's been an incredibly reliable warning sign. But they also look at things like prediction markets, a whole basket of leading economic indicators, and even gauges of pure fear in the market, like the VIX. All these clues get mixed together to build a case based on probability. Let's take a quick pause. Before we continue, don't forget to like, share, and subscribe, and check out the links in the description if you're looking for a real estate agent in your market or you need life insurance. My team and I can help you anywhere nationwide. Now, let's get back to it.
All right, now let's get into Section 4, Markets Pricing the Future. This is all about how the market tries to read its own collective mind. Here's the key idea. A market price for a stock or a bond is just a living, breathing snapshot of everyone's collective opinion about the future. It's the weighted average of millions of hopes and fears. So when you hear that the market is pricing in a recession, that doesn't mean it's a confirmed event. It just means the consensus opinion has shifted. More investors are worried, so they're demanding lower prices to compensate for what they perceive as higher risk. It's a dynamic opinion, not a proven fact.
And this is a really important distinction to make. We have to separate the tools that are trying to forecast from the tools that are designed to detect. On one side, you've got things like the yield curve, which try to give us a clue about the future. But on the other side, you've got real-time detection tools like the SAM roll. The SAM roll is a simple indicator based on the unemployment rate. And it doesn't try to predict anything. Its only job is to signal that a recession has, with a very high probability, already begun. It's a tool for understanding the present, not the future.
This all leads us to a much-needed dose of reality. Section 5, the limits of prediction. Because with all our data and all our powerful computers, the history of trying to predict the economy is, well, it's a lesson in humility.
There's this legendary quote from the Nobel Prize-winning economist Paul Samuelson. He said, Wall Street indexes had predicted 9 of the last 5 recessions. Let that sink in. What he so brilliantly pointed out is that the market has a massive tendency to cry wolf. The warning signs flash red way more often than a recession actually happens. For every correct call, there are a ton of false alarms where the entire financial world braced for an impact that never came. And that really is the bottom line here. Trying to forecast the exact timing of a recession is just incredibly difficult and full of errors. The economy isn't some mechanical clock that you can perfectly map out. It's a complex, messy system driven by unpredictable human emotions and wild cards nobody sees coming. Pandemics, wars, new technologies. The signals can tell us when we should be worried, but they can't tell us exactly what to be worried about or precisely when it's going to arrive. So, after all this, where do we land? We're at our final section, the practical takeaway. Section 6, Decoding the Headlines. This is where we put all the pieces together into a new framework for you to process financial news.
From now on, whenever you see a headline that screams, Wall Street knows when the recession will hit, this is your decoder ring. What that headline actually means is one of two things. 1, market prices have shifted because investors as a group are more worried about recession risk. Or 2, some forecaster's computer model has spit out a high probability of a recession happening in some future time frame. The entire story is about risk, general timing, and likelihood. It is never ever about a known, fixed calendar date.
And so we end with a question for you. Now that you're armed with this understanding, Knowing the difference between looking backward to date a recession and looking forward to guess at probabilities, knowing about all the false alarms, and knowing the language of risk versus certainty. How are you going to listen to the forecasts now? You're no longer just a passive listener. You're now equipped to be a critical thinker, to see past the flashy headlines and understand the much more interesting reality of what the markets are actually trying to tell us. Thank you for joining this deep dive. Before you go, a final reminder. Don't forget to like, share, and subscribe. And check out the links in the description if you're looking for a real estate agent in your market or you need life insurance. My team and I can help you anywhere nationwide. Until next time, stay curious.